Imagine you're sitting down to build a restaurant empire, right? But you decide to give yourself a deliberate, just massive set of handicaps. I mean, you absolutely refuse to franchise a single domestic location.
Right, which is wild.
Totally wild, meaning you have to pay for every single physical building with your own cash, and then you refuse to freeze your ingredients.
A ticking time bomb.
Exactly, a total ticking time bomb of spoilage for your supply chain. You refuse to install microwaves, and for the longest time, you even refuse to use drive-through speakers.
You are basically rejecting every single operational efficiency that built the modern fast food industry.
hmm
You're actively choosing the hardest possible path in a business that already has notoriously brutal margin.
Yeah, and yet, despite all those self-imposed handicaps, you are somehow opening a brand new restaurant somewhere in America every single day. Like, let that sink in for a second. Every single day, a new set of doors opens.
It's an operational anomaly. I mean, by all conventional logic, a business model that capital intensive and that reliant on fresh, highly perishable food, it should have collapsed under its own weight decades ago.
But instead, it became one of the greatest wealth compounding machines in modern retail history. So welcome back to the deep dive. If you've been with us on this journey, you know the grand mission here. We are taking the companies in the S&P 500 one by one and tearing them down to the studs. We want to know exactly how the biggest businesses in the world tick, how they generate their returns, and where their armor is actually weak.
And it has been a fascinating progression so far. I mean, in the first deep dive of our journey, we tackled Visa, digging into the mechanics of that global toll booth and asking if that fortress was fairly priced.
Which was intense.
Very. Then in the second deep dive, we unpacked Lululemon, having a rather heated debate over whether that cracked consumer brand was just temporarily bruised or fundamentally broken.
Which brings us to the third deep dive of our journey. Today, we are dissecting Chipotle Mexican Grill, ticker symbol CMG. We are framing this as arguably the most important and certainly the most heavily scrutinized unit economics story in the consumer space right now. So, okay, let's unpack this. Chipotle is a best-in-class growth machine that just hit a terrifying. As we sit here today, the stock has been cut nearly in half. It plummeted from a premium 60 times plus growth multiple down to about 27 times.
And the mechanics of that drop are what make this such a vital case study for you to understand. You're looking at a business with two very distinct, very separate growth engines.
Yeah.
So first you have the new restaurant expansion engine, right?
Yeah.
The little pouring of concrete, signing of leases, and opening of new physical doors.
Right.
And second, you have the same store sales engine, which is the growth happening inside the restaurants that already exist.
And right now we have a massive divergence.
Yeah.
The new store engine is roaring, like they are stamping out boxes at a record pace. But that second engine, the same store sales engine, just stalled for the first time in years.
Which sets the analytical table for everything we are going to discuss today. The core question for you, listening right now, is this. How much of Chipotle's valuation rides on management's ability to restart that stalled same-store engine? And conversely, how much can sheer, relentless, self-funded physical store expansion carry the weight of this company all on its own?
To really understand why those two engines are suddenly out of sync, we have to understand the physical machinery of the box itself. And that means going back to the blueprint.
Exactly. Let's travel back to 1993, Denver, Colorado. Chef Steve Ells starts with the premise that, at the time, sounded borderline ridiculous. Like, what if you take fine dining techniques, classic culinary prep, high quality, ethically sourced raw ingredients, and you apply them to fast food speed and fast food price points?
And the only way to make that math work was extreme simplicity. You create a deliberately, almost stubbornly short menu. Burritos, bowls, tacos, salads. You don't do burgers, you don't do fries, you don't do milkshakes.
No fryers.
Exactly, no messy fryers. You have a handful of core ingredients, and you run them down a linear assembly line directly in front of the customer.
But that simplicity on the front end masks an incredibly complex structural choice on the back end. Chipotle did something that makes them an absolute anomaly in the restaurant space. They're essentially 100% company-owned.
Aside from a tiny handful of international partners in places where they legally or logistically need local operators, right?
Correct. But in the United States, where the vast majority of their roughly 4,050 restaurants are located, there is zero franchising. None. If you look at the giants, McDonald's, Subway, Burger King, Taco Bell, they franchise the overwhelming majority of their locations. In many ways, McDonald's isn't even a hamburger company.
They're a real estate company.
Exactly. They're a commercial real estate company that collects rent and a royalty check from independent operators. Chipotle owns and operates virtually every single box itself.
I have to push back on this strategy, though. Opening 4,050 restaurants with your own corporate cash is insanely capital intensive. It goes against all conventional wisdom of how you scale a fast food empire.
Sure, it's expensive.
I mean, think about it. If I'm McDonald's, my franchisees take on the debt to build the store. They deal with the daily nightmare of hiring and firing teenagers, and they absorb the local fluctuations in the price of tomatoes. I just sit back at corporate headquarters and collect my 4 or 5% top-line royalty check. It's an incredibly high-margin, capital-light business. Why on earth would Chipotle leave that sweet franchise royalty money on the table and choose to take on all the operational headaches themselves?
It's the most common critique of the company, absolutely. But it comes down to a philosophical choice about margin capture and brand control. When you franchise, you are essentially trading margin for speed and capital efficiency. Yes, you get a steady, risk-free royalty check, but you give up the lion's share of the profit that the actual restaurant generates to the franchisee. Chipotle looked at their unit economics, realized their individual boxes were incredibly profitable, and decided they wanted to keep 100% of the pie.
Okay, it's like a real estate decision. Franchising is like renting out a house you own. You get a steady rent check every month, and if the plumbing breaks at 2 in the morning, the tenant has to deal with it, or at least shares the burden. It's safe, but your upside is capped by the rent. What Chipotle is doing is living in the house, upgrading the house, paying for the plumbing out of pocket, and keeping all the appreciation for themselves. If the house literally prints money, why let a tenant take a cut?
That's a great analogy. And the second reason is risk mitigation regarding the brand itself. Chipotle's entire value proposition is food with integrity. They are promising ethically raised meats, no artificial colors, no preservatives, and fresh prep every morning.
Right.
If you hand the keys to thousands of independent, profit-seeking franchisees, the temptation for those operators to cut corners is immense. A franchisee in Ohio might decide to buy slightly cheaper, non-approved tomatoes to pad their margin for the month. But if someone gets sick or the quality drops, the consumer doesn't blame the local franchisee.
They blame Chipotle.
Exactly, they blame corporate. By owning the stores, corporate maintains absolute tyrannical control over the supply chain, the food quality, and the guest experience.
But refusing to franchise creates a massive mathematical problem. If you're footing the bill for all 4,000 buildings, you can't survive on average fast food margins. You need those individual boxes to print serious cash. Otherwise, your return on invested capital drops to zero.
Which brings us perfectly to the actual unit economics. We have to dissect the financial anatomy of a single Chipotle restaurant, because the numbers here are staggering.
Let's open the hood on one of these boxes. When you look at a mature Chipotle location, it generates an average unit volume, what the industry calls AUV, of about $3.1 million a year. Let's provide some context for that. A typical run-of-the-mill local restaurant might do $1 million if they are lucky.
If they're lucky, yeah.
A fast casual restaurant selling almost entirely burritos and bowls, pulling in over $3 million annually in relatively limited operating hours, is an absolute machine.
And to understand why that $3.1 million in top-line revenue is so powerful, we have to look at the restaurant-level margin. This is the cleanest, most vital metric for evaluating how good the core business really is. It is the profit a single physical restaurant throws off before any corporate overhead, like the CEO's salary or national marketing campaigns, is applied. You take that $3.1 million in revenue and you subtract the 4 direct costs of running the box: food, labor, rent, and other operating expenses.
So if we break down their current cost structure against that revenue, where does the money go?
Let's look at the breakdown. Roughly 29.6% of every dollar goes to food, beverage, and packaging. That is actually quite high for the industry.
Definitely.
Another roughly 25% goes to labor. Then you have occupancy, which is rent, and other operating costs like utilities and insurance taking up the rest. Historically, Chipotle's restaurant-level margin sits in the mid-20s. It actually peaked near 27% during the height of their efficiency and is currently hovering around 24 to 25%.
Stop right there, because we need to explain why that food cost is almost 30% and why that demands a very specific operational strategy. If you are McDonald's or Taco Bell, your food costs are lower because your food is highly processed, frozen, and shipped in massive non-perishable quantities. Chipotle doesn't use freezers.
Zero freezers.
They use walk-in coolers. Their meat is ethically raised, which costs a premium. Their produce is fresh. And look, fresh food spoils. If you have expensive, highly perishable ingredients, you cannot afford to have a slow day. You cannot afford low volume.
Precisely. If a batch of fresh guacamole sits too long, it oxidizes, turns brown, and goes in the trash. That is pure profit in the garbage bin. The only way a model with 30% fresh food costs and 35% labor costs survives is through extreme, relentless velocity. The food has to move faster than it can spoil.
Okay, here's where it gets really interesting. How do they achieve that velocity? How do they push $3.1 million through a kitchen that's basically just a grill and a prep table? The answer is throughput. Throughput is not just a metric at Chipotle, it is a religion. It is an absolute fanatical obsession with line speed. They measure exactly how many guests they can serve per hour, particularly during the peak lunch rush between 11:30 a.m. and 1:30 p.m.
It is the defining operational characteristic of the company. Management talks constantly about the 4 pillars of throughput. And it's worth explaining how granular this gets. It's not just work faster. It is a choreographed dance.
Let's talk about the scuttlebutt of this. Think about the last time you stood in a Chipotle line. The first pillar is having the right people in the right places at peak times. You don't have your best burrito roller in the back washing dishes at noon.
Right, you need your aces in their places.
Exactly. The second is having all the ingredients prepped and ready. Nobody should be running to the back to chop cilantro at 12:15. The third is the physical execution, the exact movements of the scoop.
But the most important pillar, structurally, is the expo station, the person standing between the food preparer and the cashier.
Yes. Let's explain why the expo station is the secret weapon. When you walk into a normal sandwich shop, the person who makes your food is often the same person who rings you up. At Chipotle, the bottleneck isn't folding the burrito. The bottleneck is the customer digging through their purse or wallet to find their credit card. If the person rolling the burrito is waiting for you to pay, the entire line stops.
Exactly. The expo station's entire job is to separate the physical handoff of the food from the financial transaction. The expo bags the food, gets your drink cup, and hands it to the cashier, while the line workers immediately start on the next customer's bowl. That simple separation shaves seconds off every single interaction.
And why do those seconds matter? Let's do the math. If you shave 3 seconds off a transaction and you process 100 people in an hour, you've just saved 5 minutes. That's time to process maybe 7 or 8 more customers.
And this is where the magic of fixed costs comes in. Think about the rent on that building or the electricity bill. Those costs do not change whether you sell 1 burrito today or 1,000. Once you sell enough burritos by 11:45 a.m. to cover your rent and your manager's salaries for the day, every single additional burrito you sell in that peak lunch hour falls almost straight to the bottom line. You only pay for the marginal cost of the chicken, the rice, and the cardboard bowl. Everything else is pure profit. High throughput equals explosive operational leverage.
And they took this religion of throughput so seriously that when digital ordering started to take off, they didn't just dump the digital orders onto the front line. They physically built a dedicated second make line in the back of the kitchen.
This was a massive capital expenditure,
Yeah.
but absolutely necessary. I mean, if you were standing in line in the store and the worker is suddenly making 5 burritos for an Uber Eats driver who isn't even there, you get frustrated. The line slows down. By building a second, completely hidden assembly line in the back, they essentially doubled the capacity of the box without adding a single square foot of customer dining space.
Okay, so we've established they have this incredibly optimized cash printing box. Let's put it to the ultimate test, the $10 billion moat test. This is a thought experiment we use to separate a company that just happens to be executing well right now from a company with a true structural economic moat. If a rational, ruthless competitor with unlimited resources were handed $10 billion in cash today, and their only goal was to destroy Chipotle's market share, could they do it?
This raises a profoundly important question about what actually constitutes a moat in the restaurant industry. Pat Dorsey, who literally wrote the book on economic moats, is famously skeptical of restaurant stocks. He argues they almost never have durable advantages. Consumer tastes change constantly. The switching costs are literally zero.
Right. The switching cost is turning your steering wheel left into a Qdoba instead of right into a Chipotle. It costs the consumer absolutely nothing to abandon you.
$0.
But I'll plant my flag here.
Uh-huh.
I think if Chipotle survives the $10 billion test, it's because the moat is the brand itself. It's the food with integrity positioning. It's a cultural cachet. Customers actively bypass other cheaper options because they trust the specific ingredients, the sourcing, and the preparation at Chipotle. They feel better about eating it. You cannot just buy a decade of consumer trust with $10 billion.
I am going to vigorously take the other side of that argument. I think the brand is actually the weakest, most fragile part of their moat. We know for a fact it's fragile because we watched it break. Remember the 2015 E. coli and norovirus crises?
Oh man, the dark days.
Exactly. Because their supply chain was decentralized to prioritize local, fresh ingredients and outbreak spread, and it nearly broke the company. Their same-store sales collapsed. It erased years of financial progress overnight. A brand moat in the food business can vanish with a single bad headline. It takes years to build trust and one tainted batch of lettuce to destroy it. So no, the brand is not the moat.
Then what is? I mean, what's stopping someone with $10 billion?
The real moat is structural. It is physical. It is 4,050 perfectly located, optimized real estate leases across the country. More importantly, it is a massive, vertically integrated national supply chain. A startup cannot replicate that logistical footprint, even if you hand them $10 billion.
Okay, that's fair.
Think about the complexity of sourcing millions of pounds of ethically raised, antibiotic-free pork, fresh avocados, and organic cilantro, and delivering it, fresh not frozen, to 4,000 different strip malls and street corners every single week. It takes decades to build a supply chain with that kind of muscle.
But hold on, look at Cavia. Cavia is the Mediterranean fast casual chain, and they are openly, aggressively running the exact same playbook. They started from a single restaurant in 2011, and now they are a multi-billion-dollar public company taking the momentum narrative by storm. They use fresh ingredients, they have an assembly line, they emphasize healthy options, their revenue was up 32% recently. Cavia proves that you absolutely can build a challenger.
They do prove that a brand moat isn't impenetrable, yes. Cavia is executing incredibly well and they have tremendous momentum. But let's look at the scale. Cavia has roughly 450 restaurants today. Chipotle has over 4,000. Cavia hasn't destroyed Chipotle. They've just proven that the fast casual category as a whole can support another premium player.
Right.
But to catch Chipotle, Scava would have to build 3,500 more restaurants, secure 3,500 prime leases in a highly competitive commercial real estate market, and scale their supply chain 10x without breaking it. The scale and real estate advantage Chipotle possesses creates a brutally steep, almost vertical hill for any challenger to climb. It's not an impossible moat to cross, but it is deeply formidable.
So if we synthesize this debate, the brand gets you the premium pricing power and allows you to charge $13 for a burrito, but the scale, the logistics, and the real estate footprint are what actually protect the castle. It's a moat you have to re-earn with every single lunch service and every single produce delivery.
Exactly. And that scale advantage brings us to the second massive growth engine, operational leverage and reinvestment. Because when you have built this highly optimized cash-generating machine, the obvious question is, what do you do with all the cash it spits out?
You build more machines. Let's explore the cash-on-cash returns, because the mathematics of a new Chipotle build are wild. We just established that a mature box generates $3.1 million in annual sales. Now think about what it actually costs to build a Chipotle. It's relatively cheap compared to a massive sit-down restaurant. It's a small footprint, usually in a strip mall. You don't need massive fryers or complex ventilation for char broilers. It's an assembly line, some stainless steel prep tables, a grill, and some minimalist seating.
The initial build-out cost is usually around $1.2 to $1.5 million. So if you spend $1.5 million to open the doors and the restaurant immediately starts generating $3.1 million in sales with a 25% restaurant-level margin, you are generating roughly $775,000 in raw profit from that box every year.
Which means your cash-on-cash return is north of 50%. You make your initial investment back in less than 2 years. That is an exceptional return on capital. And this is exactly why Chipotle's management is currently pouring roughly $4.2 billion into capital expenditures over the next 5 years. They don't need to take on massive debt to grow. They are entirely self-funding their own aggressive expansion using the cash from their existing stores.
And the most important evolution of that physical expansion is the Chipotle revolution. This is the structural shift that happened post-2018 during their digital transformation.
We need to explain exactly what a Chipotle is because it's brilliant. It is not a traditional drive-thru. You don't pull up to a crackly speaker and yell your order to a teenager who can't hear you.
No, it is strictly a drive-through lane for digital pickup. You order on the mobile app from your couch or your office, you drive to the restaurant, you pull up to the window, they hand you the seal bag, and you drive away. There's no ordering at the window, which means there is no bottleneck.
This fundamentally alters the economics of the box in ways that are hard to overstate. Think about the consumer behavior shift. Digital orders now account for roughly 37 to 39% of Chipotle's total sales. They have a massive digital loyalty program that drives about 32% of their sales. They know exactly what you like when you order it, and they can send you a push notification at 11 a.m. to trigger a craving. More importantly, roughly 80% of all new locations being built today feature these Chipotlanes.
And here is why Wall Street loves the Chipotlane. It is pure margin expansion. With a Chipotlane, you are pushing drastically higher sales volume through the exact same physical kitchen layout. Because these customers never step foot inside the restaurant, you require zero extra dining room space. You don't need to buy more tables, you don't need more chairs, you don't need more parking spots, and critically, you don't need to hire extra people to clean the lobby or empty the trash.
It's the ultimate realization of the throughput religion. Higher sales volume, lower incremental operating costs, better margins, and exceptional cash-on-cash returns.
So that leads us directly into the runway. The growth narrative that management is pitching to investors right now. Their publicly stated target is to reach 7,000 plus units in North America alone.
Let's do the math on that. We're at about 4,050 stores today. That means management believes there is a 75% runway of physical growth just sitting there in their home market. They think they can almost double the footprint of the company before they hit saturation in the US and Canada.
Plus, you have this entirely untapped international optionality. Historically, their international footprint has been an afterthought, but recently they announced a partnership with the El Shaya Group to expand aggressively in Europe and the Middle East. And back home, they are trying to drive frequency with continuous menu innovations, limited-time offers like carne asada, chicken al pastors, or smoked brisket. Management refers to this combination of new units, digital leverage, and menu innovation as their recipe for growth. On a spreadsheet, it sounds flawless.
Yeah, well, I am going to throw a massive bucket of cold water on this parade right here. The spreadsheet looks great, but reality is messy. I think the fast casual margin ceilings have permanently lowered, and the era of easy profitability is over.
Really?
Because you cannot wish away the rising cost of human beings. We are looking at structural, permanent labor shortages across the entire service industry in America. Minimum wages are rising rapidly, especially in massive markets for them like California, where fast food minimum wages jumped significantly. Add to that the cost of beef, volatile freight and shipping inflation, and potential 2025 tariffs on imported goods. Operating margins literally just fell. From Q1 of the previous year to Q1 of 2026, their operating margin dropped from 16.7% down to 12.9%. Restaurant-level margins slipped down to 23.7%. I just don't see how they ever get back to that peak 27% margin in a macroeconomic environment that is structurally more expensive.
Look, I understand the pessimism, and those are real headwinds, but I would defend the resilience of the model by pointing to structural analysis.
Quick break. This show is built on the fundamental research of Yehonatan, our lead analyst and founder. Want his tools? Click the Substack link below to get 3 free resources for this company. The full deep dive PDF, an interactive valuation model to test your own growth and discount rate scenarios, and a 20-year financial spreadsheet, all completely free. Now back to the numbers.
The primary reason margins compressed recently wasn't just inflation. It was something called deleverage.
Okay, let's explain deleverage for everyone listening.
It's the dark side of fixed costs. We talked earlier about how fixed costs like rent, management salaries, insurance create explosive leverage when sales go up. Deleverage is the exact opposite. When your same-store sales stall or decline, those fixed costs remain exactly the same, which means they certainly eat a much larger percentage of your revenue pie. Your margin shrinks rapidly. But here is the key. Deleverage is reversible. If you can simply restart the sales engine and get foot traffic growing again, the leverage mathematically returns.
But how do they combat the labor costs? I mean, you still have to pay the workers more.
Automation. They are making massive investments in automation. They are currently testing AI automated make lines. They call it the cobot, a collaborative robot that physically dispenses ingredients for digital bowl orders. They are testing automated tortilla fryers. Add strategic surgical menu price adjustments to that automation, and I believe they will eventually restore that mid-20s margin equilibrium. The math of the box is simply too strong to stay depressed forever.
But that entire optimistic scenario hinges on one massive assumption, that the same-store sales engine will actually restart. Which brings us to the absolute core of today's deep dive. The bear case, the painful, undeniable truth that caused a beloved premium stock to literally have its valuation.
This is the thesis breaker. This is why the stock collapsed. For years, the Chipotle algorithm growth formula was incredibly reliable. You open about 8% new stores every year. You add mid-single-digit, same-store sales growth on top of that, meaning your existing stores sell 4 or 5% more than they did last year. You sprinkle in some very modest, predictable menu price increases. The mathematical result of that equation was a beautiful, reliable 12 to 15% revenue compounding machine. Wall Street loves predictability, so they awarded it a 60 times multiple.
But in fiscal year 2025, that beautiful algorithm broke. The comparable sales engine went into reverse. Same-store sales across the company fell 1.7%.
And we have to look very closely at the composition of that decline, because all sales declines are not created equal. Same-store sales essentially move for two reasons: transactions, which means actual foot traffic and number of orders, and check size, which is how much each customer spends, usually driven by menu price hikes. Why this specific 1.7% drop is so toxic is that transactions, actual human beings walking through the physical doors, fell by 2.9%.
So wait, let me get this straight. Total revenue for the company still grew 5.4% to $11.9 billion. So what does this all mean? It means they only grew their total revenue because they aggressively opened 334 brand new stores, and they jacked up the prices on the fewer people who actually bothered to show up at the existing stores. Raising prices to mask declining foot traffic is a deadly terminal spiral in retail. It is a band-aid, not a long-term strategy. You eventually run out of pricing power.
Let's vigorously steelman these bear arguments without dismissing any of them. The first, and arguably most existential threat, is the value squeeze.
Right. The consumer is exhausted and they are trading down. Look at the fast food giants right now. McDonald's, Wendy's, Taco Bell. They are leaning incredibly hard into $5 value meals. Their CEOs are openly talking on earnings calls about capturing the low-income, value-seeking consumer who feels stretched by inflation.
Meanwhile, what does a trip to Chipotle cost? A steak burrito, a side of chips and guacamole, and a fountain drink can easily cross $13, $14, even $15, depending on your market. When gas prices spike or rent goes up and a recessionary consumer feels the pinch, they do the math. They realize they can feed themselves at Taco Bell for half the price. They walk away. Chipotle has never competed on being the absolute cheapest option, but in a genuine consumer value war, their premium price point is a massive vulnerability.
The second major threat is the nimble upstart we discussed earlier, CAV. While Chipotle's traffic fell 2.9%, CAVA's foot traffic was up 6.8% in their most recent quarter. Total revenue was up 32%. CAVA is actively stealing the momentum narrative that Chipotle used to own. They are proving that when premium customers want a fast, casual bowl, they aren't strictly loyal to Mexican food. They are happy to migrate to Mediterranean. CAVA has a massive health halo, highly customizable ingredients, and it feels fresh and new.
Then you have the leadership void, which cannot be understated. Brian Eckel is widely considered one of the greatest restaurant executives of this generation. He is the CEO who came in during the dark days after the E. coli crisis, completely overhauled their marketing, aggressively pushed the digital and Chipotling strategy, and drove the stock price up some 775% during his tenure. And in 2024, he packed up and left to become the CEO of Starbucks.
He left a massive vacuum. And the new CEO, Scott Boatwright, stepped in and almost immediately stumbled. He sparked a massive PR backlash by talking on an earnings call about focusing the company on higher-income customers. In a tough economy where everyone is feeling the pinch of inflation, blatantly stating you only care about the wealthy demographic played terribly in the media and on social media. Wall Street is genuinely still trying to figure out how to accurately price a Chipotle without Nicole.
And finally, we cannot ignore the food safety concentration risk. 100% of this brand's valuation rests on a single, undiversified concept. It is not a holding company like Yum Brands, which owns KFC, Taco Bell, and Pizza Hut.
Right, if KFC misses, Taco Bell saves the day.
Exactly. But Chipotle is just Chipotle. The 2015 E. coli ghost is always hovering in the background. Because they own the entire supply chain, and because they stubbornly insist on fresh prep with zero freezers, one bad headline, one localized outbreak of norovirus or E. coli could tank the entire company's traffic overnight.
You lay all that out, the value squeeze from cheap fast food, the momentum theft by Via, the departure of a visionary CEO, and the constant lingering threat of food safety, and suddenly that 1.7% drop in same-store sales doesn't look like a temporary macroeconomic blip. It looks like a structural crack in the foundation of the business.
Well, if that is true, and the business is genuinely facing a mature growth crisis, it forces us to figure out how to value it. How do the greatest investors in history evaluate a stock that has fallen from the stratosphere, lost its premium momentum halo, and is suddenly trading on depressed trough earnings?
Let's run this through the lenses. This is the core of our mission, where we apply the frameworks of the master investors to our S&P 500 companies. Let's start with the Warren Buffett lens. When Buffett looks at a business, he is looking for two primary things: unquestionable quality and exceptional return on invested capital.
For a value investor looking purely at the quality of the balance sheet, Chipotle checks some absolutely mouth-watering boxes. The return on invested capital, or ROIC, is roughly 21% over a 3-year average. We need to emphasize how rare that is. The restaurant industry median ROIC is drastically lower than that, usually in the single digit. A company reliably earning 21% on the capital it deploys is a rare beast.
Add to that, they have zero financial debt, none. In an era where corporate America is drowning in leverage, they are operating debt-free. They're sitting on about $2 billion in cash. Their cash conversion cycle is essentially 100%, meaning almost all their accounting net income translates immediately into actual spendable free cash flow.
And look at how they are allocating that cash. They aren't paying a dividend, which Buffett actually prefers if the company has high-return places to put the money. They are fully funding the build-out of hundreds of new Chipotlanes, and whatever cash is left over, they are using for aggressive stock buybacks. They have been shrinking the overall share count by about 3% annually. That is textbook, intelligent capital allocation. You reinvest in your own 21% return machine, and you buy out your partners to increase your ownership stake.
But here is the Buffett skepticism, and it's a big one. Buffett historically hates restaurants. He is deeply wary of the entire sector, and it goes right back to the moat criteria we discussed earlier. Consumer tastes are incredibly fickle. The barriers to entry are low. Anyone can open a taco stand. The switching costs are zero.
Let me argue the other side of the Buffett lens, though. Does surviving the 2015 E. coli crisis, and not just surviving it, but ultimately thriving, rebuilding the consumer trust, and compounding revenue at 12% for years afterward, doesn't that fundamentally prove that Chipotle possesses a durable, Coca-Cola-esque brand advantage? A weak, commoditized brand would have simply gone bankrupt and died in 2015. Consumers forgave them because they love the product. That is the definition of consumer monopoly power.
Look, I think it proved they had a brilliantly executed turnaround led by a generational CEO in Brian Nichols, and they had the immense tailwind of a booming, stimulus-heavy, zero-interest rate economy over the last decade. But let's look at the price, because Buffett demands a margin of safety. Even after the stock has been cut in half, it is still trading at a 27 times price-to-earnings multiple. Paying 27 times earnings for a restaurant chain that is currently facing severe margin compression and actively bleeding negative foot traffic leaves absolutely zero margin of safety. If they miss earnings again next quarter, that 27 multiple could easily compress to 15.
Okay, if Buffett is wrestling with the durability of the brand and the lack of a cheap entry price, let's pivot to the Peter Lynch lens, the ultimate fast grower framework.
Peter Lynch famously categorized public companies into 6 distinct types, and for the last 10 years, Chipotle was the textbook definition of a fast grower. It was also the ultimate scuttlebutt stock. Lynch loved businesses you could physically observe. You could walk through your local outdoor mall on a Tuesday at noon, see a line of 30 people spilling out the door of a Chipotle, watch how fast the line moved, and realize this company was just going to stamp out thousands of these exact same cash-printing boxes across the entire country.
But Lynch also offered a very dark, very explicit warning about these fast growers. He warned that when a growth story eventually matures, when the underlying metrics like same-store sales begin to slow down and plateau, the multiple compression is savage. Wall Street punishes you severely for growing up. That brutal drop from 60 times earnings down to 27 times is exactly what Lynch predicted happens when the same-store growth engine fails. You are suddenly re-rated by the market as a normal, mature company, not an unstoppable rocket ship.
Let's look at a classic Peter Lynch metric, the PEG ratio. For anyone unfamiliar, PEG stands for price to earnings divided by the growth rate. It's a way to see if a high PE is justified by high growth. A PEG of 1.0 means a stock is perfectly fairly valued relative to its growth. Right now, Chipotle has a PEG of roughly 1. By Lynch's standard, a 1.8 is getting quite expensive.
It's tricky, though, because we have to introduce the concept of trough earnings. That 1.8 PEG might be an illusion.
Explain trough earnings for the listener.
Well, the E in the PE ratio stands for earnings. Right now, Chipotle's earnings are depressed due to the temporary margin squeeze we spent so much time discussing. Inflation, labor costs, the deleverage from negative traffic. Their net income was basically flat between 2024 and 2025. When your earnings shrink temporarily, your PE ratio mathematically spikes, making the stock look artificially expensive. If management can implement the robotic make lines, stabilize prices, and get traffic back, those earnings will explode upward, and that 27 multiple will suddenly look like it was incredibly cheap in hindsight.
I'll take a firm stance here. I don't buy the trough earnings argument. I insist the 10-bagger phase, the era of multiplying your money tenfold in Chipotle, is officially over. It is actively transitioning right now from a Lynch fast grower into a Lynch stalwart. A stalwart is a large, mature company that will grow predictably, maybe 6 or 7% a year, but it isn't going to double your money every 3 years. The law of large numbers has finally caught up with them. You simply cannot compound 4,000 stores the same way you compounded 400.
I completely, fundamentally disagree with that assessment. I think the 7,000-unit North American runway proves they are still very much a fast grower. They are only at 4,050 stores today. They have 75% more physical units left to build just in their core, proven home market. A long unit runaway means the stock can still fly if the comparable sales simply stabilize. And we actually saw a glimmer of that stabilization. In Q1 of 2026, transactions finally ticked back up a positive 0.5%. It's tiny, but it's positive. If that transaction line confirms the turn, the unit runway carries the whole story back to a premium valuation.
Let's add Philip Fisher and Howard Marks to the mix to break this tie. Fisher was all about scuttlebutt. Just like Lynch, Fisher's advice would be to get out from behind the spreadsheets and the 10K filings. Go stand in a Chipotle restaurant at noon on a Tuesday. Watch the expo station. Is the line actually moving? Is the food hot and fresh? Are the employees smiling or overwhelmed? Are people happy to pay $14 for the bowl?
And Howard Marks applies what he calls second-level thinking. First-level thinking is easy and reactionary. First-level thinking says, the same-store comp stalled, inflation is high, the genius CEO left for Starbucks, sell the stock immediately.
Right, that's what deadlines say.
But second-level thinking asks the deeper question. Everyone in the entire market already knows the comp stalled. Everyone already knows Brian Niccol left. All of that bad news is already perfectly priced into the 45% haircut the stock just took. The second-level thinker asks, is the market's pessimism now heavily overdone relative to the actual undeniable long-term cash flow this debt-free business will produce over the next 10 years?
Okay, we have debated the mechanisms. We have the data. We have the frameworks. I am forcing the issue right now. Final ultimatum. Would Buffett and Lynch buy, hold, or pass on Chipotle today? I'll go first, and I won't capitulate. I think Peter Lynch would classify this as a hold. He would look at the stalling traffic and say, I am not buying more shares until I see definitive, sustained confirmation over multiple quarters that foot traffic is actually returning. But it's still a phenomenal business, so I won't sell what I already own just yet.
And Buffett.
I think Warren Buffett would firmly pass a 27 times earnings multiple on a restaurant that is actively leaking market share to CMG and losing the value consumer to Taco Bell simply does not possess the impenetrable, inevitable moat he requires. He would put it in the too hard pile.
And I will take the exact opposite view and defend it. I genuinely believe Peter Lynch would buy this stock today. The core of his entire philosophy was finding massive unit growth runways in businesses he understood. The runway to 7,000 stores is massive and tangible, and that Q1 stabilization of plus 0.5% traffic is exactly the early green light he'd be looking for to jump back in.
You really think Buffett would buy a restaurant at 27 times earnings?
I argue Buffett would absolutely buy. Look past the sector bias. You are looking at a debt-free cash machine generating 21% returns on invested capital, buying back its own stock aggressively, and it's currently trading at a 50% discount to its historical multiple. For a business of this sheer operational quality, that is a rare fat pitch. Buffett loves buying wonderful companies at fair prices when they hit temporary speed bumps. This is the definition of a temporary speed bump.
Well, we vehemently agree to disagree, which is honestly the hallmark of a truly fascinating market puzzle. We leave the ultimate choice to you, the listener. It comes down to your personal interpretation of the fundamental health and future of that single physical restaurant box.
If we synthesize the key themes of this entire deep dive, Chipotle remains an absolute masterclass in unit economics and operational leverage. The balance sheet is a fortress. They have zero debt. And the 7,000 store unit runway is completely intact and entirely self-funded by the cash they generate.
But the entire investment thesis, the reason the stock is such a violent battleground right now, rests on a single binary variable. Is the American consumer just taking a temporary breather because inflation squeezed their wallet? Or has the Chipotle brand permanently leaked its traffic to fresh upstarts like CAVA and the aggressive value menus of legacy fast food?
And the beauty of this deep dive is that you now possess the structural framework to watch this story unfold in real time. You aren't just looking at a squiggly line on a stock chart anymore. You're looking at how a physical, assembled-to-order burrito moved efficiently down an assembly line translates directly into a 21% return on capital.
Before we go, we always like to leave you with a final provocative thought, something to mull over that builds on everything we've discussed today, but pushes it one step further.
Think deeply about the core concept of throughput. It has been their religion, their primary lever for growth, for over a decade, shading seconds off the transaction. But we live in a physical universe, bound by the laws of physics. There are only so many seconds in a minute. If mobile ordering is already implemented, if a dedicated second make line is already running at full capacity in the back, and if robotic dispensers are taking over the salsa, wait, scratch that. If they're taking over the salsa, what happens when a fast casual restaurant reaches the sheer, literal physical limits of human space-time? When human hands, or even robotic arms, physically cannot fold a tortilla or process a credit card 1 millisecond faster? Where does the massive margin growth come from then?
That is the literal wall of space-time hitting the corporate profit margin. Incredible to think about. Well, this was part 3 of our journey through the S&P 500. Next time, we are pivoting away from burritos and diving straight into caffeine. We will dive into Monster Beverage, ticker symbol MNST. It's a wildly high-margin energy drink business with an extraordinary long-term compounding record, and it presents a fascinating test for these exact same Buffett and Lynch frameworks.
It's a completely different kind of moat, driven by distribution and marketing rather than real estate, and a completely different kind of consumer dependence.
Be sure to follow the show so you don't miss that deep dive. We'll see you next time.
If you enjoyed today's analysis, make sure to follow the show on your favorite podcast app so you never miss an episode. As a reminder, this podcast is for informational and educational purposes only and does not provide financial, investment, or legal advice. Investing involves risk, and you should always do your own fundamental research and consult a qualified professional before making any financial decisions. Thanks for listening, and we'll see you next time.